It is 9:31 a.m. The open just hit, your screen is red, and the position that felt fine yesterday is now down more in 5 minutes than you plan to lose in a week. Your heart rate jumps, your mouth goes dry, and a simple question takes over your whole mind. Do I get out right now? Or do I hold and hope? That feeling is fear, and in trading it is not a flaw. It is a survival system. The problem is that markets are not lions. Markets are uncertainty machines. They punish the same reflexes that keep you alive in the woods. If you do not understand how fear changes your decisions, you will call it bad luck, when it is often predictable human behavior playing out under stress. Fear shows up in two classic moments. The first is when you are losing. The second is when you are winning and you are scared to give it back. Both can wreck a good strategy. Both can turn a small drawdown into a career-ending event. Drawdown means the drop from your peak account value to your current value. It is not just pain, it is math. A 50% drawdown needs a 100% gain to recover. Fear makes people ignore that math. They chase the fastest way back. That is how leverage sneaks in. Leverage means borrowed exposure. It makes gains and losses bigger than your cash. Leverage is not evil, but it is unforgiving. It turns normal volatility into tail risk. Tail risk means rare moves that are much larger than normal, the kind of move that breaks models and margin accounts. Fear makes you either grab leverage to win it back or freeze and refuse to cut risk while the position grows into a tail event. I want you to picture 2008. Even if you were not trading then, you have seen the charts. The fear was not abstract. Liquidity disappeared. Liquidity risk means you cannot sell at a reasonable price when you need to. In a crisis, the bid vanishes, spreads widen, and stops do not fill where you expect. People learn the difference between a theoretical loss and a real one. During that period, many investors discovered that diversification can fail when you need it most. Correlation means how assets move together. In calm times, correlations can look low. In stress, correlations often jump toward one, meaning everything falls together. Fear does not just move prices, it changes the structure of the market. That is why I talk about regime shifts. A regime shift is when the market changes its behavior, like going from low volatility to high volatility. Volatility means the size of typical price swings. In a new regime, your old position size can be wildly wrong. Fear is often your first signal that the regime changed, but fear is also the thing that makes you deny it. One of the cleanest examples of fear meeting leverage and correlation is LTCM in 1998. Long-term capital management used heavy leverage on trades that looked low risk based on historical relationships. Their models assumed spreads would converge. When Russia defaulted and stress hit, spreads widened instead. Correlations changed, liquidity dried up, and forced selling began. Forced selling is when you sell because you have to meet margin or redemptions, not because it is a good price. Fear did not just live in their heads, it lived in the funding markets. When lenders get scared, the game changes fast. Now, bring it back to the individual trader. Fear has a few predictable tricks. The first trick is loss aversion. Loss aversion means a loss feels about twice as painful as an equal gain feels good. That pain pushes you to avoid realizing the loss. You do not want to be wrong. So you widen the stop, you rationalize, you look for one more bounce. The position becomes an identity issue. Your brain treats selling as admitting failure, even though selling is often just risk management. Jesse Livermore is often remembered for big wins, but his story also shows how psychology can turn against you. He had periods of discipline and periods of overreach. The market did not beat him in one clean fight. It wore him down through decision fatigue, pressure, and the temptation to size up after success. Decision fatigue means your judgment gets worse after repeated stress and choices. Fear and ego take turns driving the wheel. The second trick is panic selling. Panic selling is not just selling, it is selling without a plan because your nervous system wants relief. Relief becomes the reward. You exit at the worst moment, not because the trade thesis changed, but because your body demanded the pain stop. Then the market bounces, and now you feel shame, and shame is gasoline. It pushes you to revenge trade. Revenge trading is not anger at the market. It is an attempt to erase a feeling. It is fear of being behind, fear of looking stupid, fear of missing the rebound. You start trading for emotional repair instead of expected value. Expected value means the average outcome if you could repeat the same decision many times. Most good strategies have a modest expected value, not a miracle. Fear makes you abandon repetition. You stop playing the long game and start playing the next 5 minutes. The third trick is the need for certainty. In markets, certainty is expensive. You pay for it with bad entry prices, oversized positions, or late decisions. When volatility rises, the brain wants a story. So you latch onto narratives, gurus, headlines, anything that feels solid, but the market does not owe you a clean explanation. Ray Dalio talks publicly about how painful it was to be wrong early in his career, and how that pain pushed him to build a process that respects uncertainty. I respect that because fear can be useful if it makes you build better systems. The goal is not to become fearless. The goal is to become less fragile. Fragility means small shocks cause big damage. Leverage creates fragility. Concentration creates fragility. Hidden correlations create fragility. A fragile trader needs the market to behave. A robust trader can survive when it does not. Warren Buffett is often described as calm in crises. I cannot know his emotions, but I can observe his structure. He tends to avoid leverage, he keeps liquidity, and he buys with a margin of safety. Margin of safety means you leave room for being wrong. That is a fear-friendly design. It does not require perfect timing. It does not require constant action. Charlie Munger spoke often about incentives. Incentives matter because fear is amplified by career risk. Career risk means you might lose your job or clients if you look wrong in public, even if your long-term view is right. Many professional blow-ups are not just bad trades, they are incentive failures. People take hidden risk to avoid looking bad in the short term. Look at Barings and Nick Leeson. That case is a masterclass in fear, control failures, and the way small losses turn into catastrophic ones. The mechanics are well known. Positions were hidden, controls were weak, and losses were rolled forward. But the psychological engine is universal. Fear of admitting a loss, fear of punishment, fear of losing status. So the bet gets bigger. The trader is not trying to win. He is trying to escape. That is the darkest form of risk-taking. This is why I say risk management is not a spreadsheet. It is behavior under stress. Variance is the technical term for how spread out outcomes are. In plain language, it means how wide the range of possible results is. High variance strategies can be profitable, but emotionally brutal. They create long losing streaks. If you do not plan for that, fear will force you to change the system at the worst time. You will quit right before the edge shows up. Edge means a repeatable advantage, a small tilt in your favor over many trades. Most edges are thin. They need consistency and survival. Fear attacks both. So what do I do with fear in my own trading and investing? I treat it like a signal, not a command. If I feel fear, I ask what kind it is. Is it fear because I violated my own risk limits, or fear because the market is volatile but I am within plan? Those are different. The first means I need to reduce risk now. The second means I need to breathe and follow process. Position sizing is the main lever. Position sizing means how big you are relative to your account. Most psychological problems in trading are position sizing problems wearing a mask. If one candle can ruin your month, you are not trading, you are gambling with a timer. I also respect risk of ruin. Risk of ruin means the probability you hit a loss so large you cannot recover. financially or psychologically. You can have a positive expected value strategy and still go broke if you size too large. This is where the Kelly criterion comes in. Kelly is a formula for optimal bet size that maximizes long-run growth. But in plain language, it says this: the closer you bet to the limit, the more your results swing, and the more likely you are to break. Many professionals use fractional Kelly, meaning smaller than the formula, because survival matters more than theoretical optimality. I pay attention to convexity too. Convexity means your payoff improves when volatility rises, like owning options. Most traders are short convexity without realizing it. Short convexity means you make small, steady gains, then lose big in a shock. Selling options can do this. So can leveraged mean reversion. Fear is often the moment you discover you were short convexity. The losses accelerate as the market moves against you. If you do not know your convexity profile, you do not know your real risk. There is also reflexivity. Reflexivity means prices can move because people react to prices, creating feedback loops. In a panic, selling causes more selling. In a melt-up, buying causes more buying. George Soros is known for talking about this concept publicly. You do not need to trade like Soros to learn the lesson. In a feedback loop, fear is contagious. Your job is to avoid being forced into the crowd at the worst time. And that brings me to the simplest practical truth. The market can stay irrational longer than you can stay solvent, not as a quote to worship, but as a risk reminder. Solvent means you can meet your obligations and keep playing. If fear pushes you into leverage and concentration, you lose the ability to wait. Fear also distorts time. It makes you focus on the next tick. But most real wealth in markets comes from letting time do the heavy lifting.